Hello, everybody. So the market continues to mistreat hypergrowth today. I've rarely seen such anomalies, to be honest. There must be a liquidity issue going on or something, because all of the teeny tiny small caps that perform very well are dumping. And it's the case of Nebius. Nebius down 24%. I mean, we just had AMD talking about how the demand for AI is through the roof, and the market is having some sort of a manufacturer freak out about AI. I don't really know what's going on. The market kind of stuck to this headline this morning about SoftBank selling the NVIDIA stake. Well, it turns out they sold that stake because they made a lot of money on it and they want to move on to new investment. That's not because they don't believe in AI. Let's talk about Nebius. Nebius reported earnings today. In my view, these earnings were very much outstanding, especially for the fact that they announced another deal, another big deal, this time with Meta, $3 billion. It almost makes you wonder if they should have made a separate announcement maybe a few days before the earnings report, because this kind of got buried in the headlines, and it's a big deal. $3 billion is a big deal. After Microsoft for $19 billion. This is a company who's able to sell its compute to top big tech firms, and that's because the CEO of Nebius was himself the leader of a big tech firm. He has a lot of contacts as the former CEO of Yandex, and I think that really helps them get these contracts. What I find the most impressive about Nebius is their growth. And so we're going to do a little bit of valuation and computation here. So they've announced this crazy number, strong momentum into 2026, saying they should do between 5 and 9 billion of annualized revenue run rate at year-end 2026. So that's in 14 months, right? I mean, 15 months, 14 months. That's crazy. That's in no time. That's in next to no time. Like call it a big year. They should reach, say $8 billion. What is the trailing 12-month revenue right now? It's 345 million. So to me, you have a company that is underhyped here, to be very, very clear, because this is a company that's gonna well over 10x the revenue. No matter how you put it, they're gonna 10x the revenue. They're only trading at 4 times sales trailing 12 months. If you actually look at that, they're trading even less. If you look at the forward number. That's the forward number, by the way. That's what I meant. Anyways, the past growth has been 350% year over year, 39% quarter over quarter growth. They have their funding. They can fund that growth. They are fully sold out. They're gaining hyperscalers, major customers. Cursor is a top app among developers and coding, and they're getting that company to buy the product. So I don't understand that valuation. And no matter how I calculate it, the valuation I get is under 0.01 on my enterprise value over gross profit over revenue growth spreadsheet. In other words, this stock is so cheap because of that insane growth that's upcoming. So they also stabilized EBITDA. Adjusted EBITDA is at 19%. So I'm putting 19% here in all of my spreadsheets. So let's go. So when I looked at the Microsoft deal, and I just took that $18 billion number and I divided it by 5 years, and I arrived at them roughly increasing revenue by 16 times. So 1600% is what I've been using as my number for this company for the past month and a half or something like that. So that's my number right now. And using trailing 12-month revenue, you get 345 million. So EV over GP over RG is 0.08. But here's the thing. Let's kind of change the spreadsheet a little bit, and let's use annualized. I'm using annualized revenue run rate, right? ARR, and I'm using the ARR for as of right now, right? As of September end, their revenue in ARR was actually 551 million. So they're going to move from 551 million to 7,000 million, 7 billion. You could say if you in a negative scenario in 15 months, or you could just be positive and think they're going to achieve that by Q3 of 2025. In which case, this number right here is probably much closer to the real valuation. So we are at a 0.06 on EV over GP over RG. This is nowhere near bubble territory in my view. This is very, very cheap. And if you're going to be optimistic realistic. And you're going to think that this company is going to do $9 billion in revenue at year-end 2026. And right now, we are a run rate of $555 million. That means you think it's going to 16-fold. Revenue is going to 16-fold. So 1,600%, you get a 0.05. So this company is cheap. And if you're super bullish on the sector, you might even say this company is super cheap. I mean at 0.05, we are getting near valuation like Oscar or LifeMD, but for a sector that is very, very, very hot. So I don't understand this. The initial reaction of this price a few weeks ago, trading at $130, was the $130 a share. That was the initial reaction. So there's some liquidity issues going on, that all of these hyper growth stocks are being sold off. That's just an opportunity. I mean, October has been filled with opportunities. November is not rebounding. We're filled with opportunities. We need the government to reopen. Government's reopening. The market is not even responding to that. I mean, that's why I really think it's a liquidity problem, because it's not just the news. The news that the government reopening is not what we need. We need to wait until Sunday so that we get like a formal reopen on Monday and the funds to actually be distributed. So this is going to take more weeks, I think, to fix that liquidity. Anyways, I'll conclude with this. Nebius, and that's another side reason why I've always liked Nebius. I've been talking about it pretty much since IPO, this stock. The side reason I love it is, remember, enterprise value on this stock is $95 billion, but they have two important businesses. So of course I'm a believer in Tesla's solution, but that doesn't mean Waymo, and that doesn't mean in the case of AV-Ride, which was the former Yandex division, that doesn't mean these self-driving divisions are not valuable. In fact, they are valuable to Uber pouring in hundreds of millions into AV-Ride, and so they are growing that. They're going to make some money from that. And, as a spin-off, I hope they spin it off at some point and get some cash from that. So that value needs to be subtracted from the $25 billion enterprise value. And then the next one is ClickHouse. They own 28% of ClickHouse. ClickHouse is said to have something like a $6.3 billion valuation. But here's the thing. ClickHouse is, with Databricks, a competitor of Snowflake. Snowflake is a $92 billion company. Snowflake's value is going up. So I've seen people argue that in an IPO, ClickHouse could be in the tens of billions of dollars. It could potentially IPO at, say, $20 billion. And in that situation, 28% of that, well, you remove a lot of value. The market is not giving any value to the stake of Nebius in ClickHouse. And the last thing I'll say is they have done an outstanding job at acquiring electricity, and this electricity right there is also going to be pretty valuable in the future. And I am not sure if this is represented in the stock price right now. They're on track to have 2.5 gigawatt. When I think about companies that have 2.5 gigawatts, I think about companies with similar to higher market cap, right? A lot of their peers, Iron, CoreWeave, Nebius is in that same league. But for some reason, we are not getting that valuation, even though their execution is arguably much better. And so I don't understand it. This stock, probably because this stock is a new issue, it's trading on the cheap. That's the way I look at it. I'm very pleased with this Q3. I think the stock is doing well, and it's a no-brainer for my portfolio. So anyways, this was not investment advice. This is not financial advice, only entertainment on this channel. I hope you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.